Welcome back. Earlier today, I had the opportunity to talk to Dean Fergie from Cyan Investment Management. I started by asking Dean whether the froth and the bubble from last year and the number of new listings had carried through into the new year. So there was a big rush towards the end of last year to list stocks. Has that continued into 2021?
Yeah, look, it's fair to say it has. I mean, the Australian market has its normal sort of Christmas Day to Australia Day off where nothing really gets done. But certainly in the last couple of weeks, we've probably seen 3 or 4 potential new raisings, and the corporate window for just private placements and the likes opened up as well. So I think even a company called Whisper that does sort of text messaging for corporates, that they raised, I think it was $40 or $50 million the other day. So there's definitely activity, but more importantly, there's also the funding available that people have still got money in their pockets, and they seem to be happy to support these raisings. So I'd say, from that perspective, the early signs of 21 look good. It's not like there's no bullets left in the gun. I think there's more shots to be fired on the new raisings and corporate side of things.
And are they quality raisings, or are you seeing that sort of frothy end of the market that sometimes happens where you get some average stuff come to the market?
Yeah, look, I mean, I think with all this stuff, Chris, kind of time will tell. That you can say these businesses maybe don't look good initially, but then a year or two down the track, they either prove themselves or they don't. Really mixed bag. In a lot of cases, there are a number of early stage businesses that are looking for that growth capital, and that's what you expect at the small end of the market. We certainly haven't seen the bigger established businesses that, looking to raise in the hundreds of millions come to market as yet, but that tends to be normally a longer process to try and canvass investors. So, look, I mean, the quality is a bit mixed, but again, you can cherry pick ones and that can do quite well. That's sort of the name of the game, certainly at our end.
Yeah. Dean, we were talking earlier, saying 12 months ago, no one would have guessed where the market would be now. And no one had any inkling of what was really ahead of us. And as you know, fear and greed, panic gripped the market, and everyone's got on with it since because they've got time and money in their pocket. But where do you see it going from here? Is it possible to have a crystal ball, or is it just dangerous to have a crystal ball?
I've been looking for a crystal ball for about 20 years, Chris, I have to say. Look, it's really, really hard to tell. There's so many conflicting factors in the market. There seems to be a wave of money and support coming into the market. It's being buoyed by low interest rates. And, even though there were some fears in the last couple of weeks about longer term rates rising, the Reserve Bank came out the other day and said they see rates at 0.1 for the next 3 years. So that should help stabilise the market a little bit. You've also got a range of valuations, certainly stuff in the tech and fintech sector and possibly the biotech sector. And across the board, valuations look pretty extended on a long-term basis, but maybe, we could be moving into a new paradigm. So what we think is expensive now is going to look normal in a few years. So, I certainly don't subscribe to the view that the market's going to pull back by 10 or 15%. I don't see, in terms of the underlying dynamics of the market of buyers versus sellers, there being a great wave of sellers not being met by buyers. I'd see it sort of maybe remaining volatile and potentially edging upwards over the next 12 months. Would be my best guess for whatever that's worth.
Oh, look, I'm sure it's worth a lot, Dean. You've been in the market a long time. It is a difficult market. We're getting different opinions. A lot of people say this is overbought, that interest rates are going up, inflation, et cetera, but central banks have been praying for inflation and trying to create inflation for the last 2 or 3 years. And all of a sudden, there's some signs that there might be some inflation there, and everyone's running scared of it.
I mean, it is a sort of a mantra of be careful what you wish for. Like, there's been so much government stimulus certainly pumped into the domestic economy. It's no surprise that prices have crept up. You were talking earlier about the demand for leisure goods. It seems to be possible to buy a bicycle in Melbourne. Boat sales are going through the roofs, motorcycles, consumer electronics. It's all gone crazy. So the fact that there's going to be a bit of inflation creeping in seems to be obvious. Probably the question everyone needs to be asking themselves is, what happens when these government stimuluses start tailing off? That I think is maybe the concern. Certainly at the consumer discretionary end of the market is will the big bump up we've seen over the last 12 months in terms of consumer behaviour, will that continue? And I think that's where there's a big question mark over that part of the economy, is that it may subside, or indeed that consumer discretionary income moves on to more travel, more eating out, that kind of things, and it kind of leaks away from the main beneficiaries we've seen over the last year.
Yeah, it is a confusing market because there are so many conflicting signals, aren't there? Which makes it difficult for you as a professional manager in navigating that. How do you go about it?
Look, I mean, firstly, it's kind of a pipe dream to say I'm looking for reasonable growth stocks that are trading at cheap value. They just don't exist. The only cheap stocks are the ones that have got really major headwinds or structural problems with the balance sheet, which businesses we try and avoid. Our sort of perspective, and I mean, we probably always have it, but it seems even more important at the moment, is to have a really diversified portfolio. You do need a good core of solid, commercially proven, profitable, dividend-paying businesses with a bit of growth. Now, you're not going to buy those on 10 times earnings, but if you buy them on potential earnings yield of low, like even 3 or 4%, that's well ahead of the interest rates. So that's positive. And I think there's so much excitement and buoyancy in the stock market that you can have a number of businesses that are newer stage, a bit more speculative, but can add some great alpha to your portfolio. So if you combine them with that, we think it's a good way to play, I suppose, the excitement and buoyancy in the market, as well as having I suppose a strong core that will be defensive if there is a reasonable downturn. Now, I mean, I know I said I didn't think there'd be a downturn, but I have been wrong before in my professional life as an investor, so we certainly would never rule that out.
So what's the portfolio looking like at the moment? How many positions do you have in the portfolio?
We've got about 35. Now, we're starting to probably wind that back a little bit. A number of businesses have had very, very strong runs over the last, even 3 months, that we're seeing, a few companies that are probably up 30% on where they were, at the end of last year. And so you have to reassess the weightings of those and whether you want to keep them in your portfolio. We want to have a little bit of room for new issues. And I think we're probably becoming maybe slightly more nervous. So at the height of the market, when the portfolio was running at about sort of 14, 15%, we're sort of winding that back towards 20. We may even go a little bit higher over the next few weeks, just, for those reasons.
That's your cash level.
Mm.
You always used to hold quite a high cash level, but it sounds as if that's come back a bit.
Yeah, look, I mean, certainly in the last year, it's been, a remarkable opportunity to make, a substantial amount of alpha in the stock market. And I suppose we've sought to take advantage of that. The fact that there've been a number of new issues have also absorbed a bit of capital that I think largely we've done quite well out of. I think our year returns to the end of February were about 30% for the 12 months, and to the end of March, they'll annualize at about 50 or 60 after the big downturn. So the bounce back in the stock market, certainly the smaller end, has been extraordinary, and I think we've seen that opportunity and wanted to be as weighted towards it as we could be. Just time to take a few of extra chips off the table, because there are, if not rising risks, certainly the valuations are less compelling than they were 3 or 6 months ago.
Sure. And still stick to the smaller end of the market, the small to mid cap?
Look, I mean, that's where we think the opportunity is. That's where the inefficiency in pricing is. That's where we're finding businesses before the larger players. And that's where the growth's available for these stocks. It's much easier to grow a smaller business than a larger business. And that's what we like to see is underlying growth. And when you're running, a modest amount of capital, you don't need to be looking at the $1, $2, $3 billion businesses in order to deploy capital. You can find nice businesses with a couple of $100 million, invest in those and get a nice return. So that's the name of the game for Cyan anyway.
Well, that's always been your DNA, as it were, to stick to the knitting, stick to what you do well. If you're tracking at 30% end of February, 50% to the end of March, long may it continue, Dean. It's been great talking to you. It always is.
I think those kind of returns won't continue as such. But look, I mean, our view is if we can generate a return, in the double digits, 10 to 15%, without taking too much risk, or without playing in the really speculative end of the small cap market, by buying real businesses that are growing modestly without too much in terms of external factors to risk, to give them financial risk, then I think that's a good way to play it. Long-term returns over 6 years are kind of 17%. So I think most investors should be pretty happy with that. Certainly in an environment where if you're leaving your money in the bank in a term deposit, or whether you're getting less than 1%, it's not a bad return.
I think it's a great return. Of course, that's one of the things really driving the market, and I think will continue to drive the market. Dean Fergie, thank you very much for your time. Always good to talk to you.
Yeah, you too, Chris. Thanks.